I am Dr. Jasminal Kaur, working as an associate professor in CGC Landra. Today I am going to present a topic on financial markets and in its instruments. This topic is very important because financial markets becomes the linkage between the investors as well as the borrowers, and it provides the wealth to the nation, and it builds the economy as well. So starting with this, so first of all, everybody, you must be knowing that what is a finance is basically a administration of money itself. It includes activities like investment, borrowings, savings, as well as lending of the money, right? And when all these activities comes under a certain system, that system will be known as financial system. So financial system, or in the Indian financial system, we have four components under this Indian financial system. So first is financial institutions, second is financial markets, third is the financial instruments, and fourth is the financial services. So one by one we will be discussing these parts. So first is the financial institutions. Now the financial institutions are basically the intermediaries. Why the intermediaries? Because they become the linkage between the investors as well as the borrowers. Because investors have the surplus money in their hand, they want to deposit that money. For example, through banks, they deposit their money in the form of saving accounts or in the form of current accounts, whatever the accounts they want to have in the banks. And the borrowers who want to have a money, they will take a loan from the banks and utilize those money in the more productive manner so that they can get return out of it. So financial institutions are intermediaries in nature. Financial institutions are further classified into three parts, that is the regulatory institutions, intermediaries or banking, and third is the non-intermediary institutions. When we talk about the regulatory institutions are those institutions which are regulatory in the nature. For example, RBI, that is the Reserve Bank of India, it becomes it is the apex bank of our country, and it controls all the banking system. Same way SEBI, that is the Security Exchange Board of India, that is also a regulatory body which regulates all the stock markets. Under the second layer, it comes the banking system. So for example, we have ICICI Bank, we have HDFC Bank, or we have SBI Bank, which is a public bank, and we have private banks, we have public banks as well as foreign banks to provide the or becomes the intermediary for the investors as well as for the borrowers. And thirdly are the non-intermediary institutions or non-banking institutions. They are having the same functions of the banks, but they are not registered under the Banking Act. For example, your Muthoot Finance, your that is Mahindra & Mahindra Finance company, that is giving the services of banking only, but they doesn't come under the exactly under the banking system. So this was about the financial institutions. Second component in the financial system, that is the financial market, which is our main topic. So here I will be just explaining what is it, and in the later PPTs I will be explaining these all. So financial market is a place where the trading of financial instruments will take place. So under this we have two categories or two classifications. One is the money market and second is the capital market. So I will be explaining money market as well as capital market in the later stage. Third, that is the financial instruments. So the financial markets which deal in the the instruments, that is like shares, bonds, mutual funds, or they are providing this is the financial instruments. So these are like the debentures, equity share, preference shares, or the mutual funds which the financial institutions helps in making the financial transactions. Then comes the financial services. Again, nowadays, all the banks are providing the financial services like banking facilities as well as investing facilities as well as credit rating facilities for giving the credit to the individual or to the company or even to the country as well. So then is the merchant banking services. So financial services are nowadays very important because the financial intermediaries are providing the financial services, because it is if these facilities are given, only then our country will prosper. So now I come to the main topic, that is the financial markets. So financial market basically is a market where the financial instruments are traded. Now the financial instruments already explained, that is the shares, debentures, bonds are traded, and the financial services which are provided to the persons who require those services. So financial markets basically deals in these, that is the financial instruments as well as the financial services. So financial markets are divided into two or classified into two, that is the money market as well as capital market. When we talk about money market is a market where you can raise the fund for 1 day to the 1 year, that is for the short term part. So in the short, if you want to raise your money for the shorter period of time, that is up to 1 year, you can go for the money market. And again, money market is categorized into two parts, that is the organized money market and unorganized money market. Then second category or the classification under the financial market, that is the capital market, which is for the longer period of time. Here the funds can be raised for more than 1 year, that is mostly for 7 years, 10 years, 15 years, you go for, at that time you go for the capital market. So again, capital markets are categorized into three, that is primary issue market, stock market and the derivative market. So I will be now explaining about the money market. So money market is a market for the short period of time, that is for the if you want to raise your funds for 1 day to the that is up to 1 year, you will go for the money market. So here it is a market for borrowing and lending of short term funds, and already explained, short term funds means from 1 day to the up to 1 year you can raise your funds. So it is the mechanism through which short-term funds are loaned or borrowed. And here, as the name says, that money market. So actually it is not dealing in cash, but it is dealing in instruments. Rather than cash, it deals in the instruments, in which the instruments can be converted into the cash within a short span of time. For example, it can be converted into the cash for in a 1 day or maximum 2 or 3 days. You can convert, and here the transaction cost is also very, very low. So money market is a market where the funds can be raised for a shorter period of time and through certain instruments. So characteristics first, that is it is raised for the shorter period of time. Funds can be raised for, that is not exceeding the 1 year. Second is it deals in the financial assets only, not in the cash, but it is deals in the financial assets which can be converted into the cash for a shorter, in a short period. Then is it there is no formal market, as we know that whenever we want to have a product, we go for certain market, but here it is not having any market. By telephonically or by emails you can raise your funds. Then is transactions are made without the help of any brokers. So no brokers are required whenever we go for the money market, and mostly the commercial banks are dealing in money market itself. So money market have 4 components. that is call money market, collateral loan market. Then is bill market, or it is known as discount market or acceptance market. So one by one we will be discussing. So call money market means that when you want to raise your funds for one day or even one night or up to 15 days, you can raise your funds in a call money market. And most of the commercial banks, when they have to give the payment to their clients or heavy payment to their clients, they don't have cash available in their branches. What they do, they just call another banks and they can raise their funds in the call money market itself. And there is no securities is required against that particular loan. So it is without any collateral security. Then is second market, that is the collateral loan market. As the name says, it says that whenever you are going to raise your funds, you have a certain collateral security against this, only then you can raise the funds. Again, commercial banks are dealing in these transactions in the loan market, where they can raise the funds up to 1 month with the collateral security. So third, that is the money market or discount market. So if you are carrying a bills of exchange in your hand, and as in the bills of exchange, you will get the money only up when the maturity date will come. So in that case, if anyone is in the need of money earlier before the maturity date, in that case you can go in your bank where you have an account, and in that you can go and you can encash that particular bills of exchange. So it is no, and bank will deduct certain amount and will give you the whatever the amount is written in your bills of exchange with the deduction of few money. So it will be done through discount market. Fourth is the acceptance market. Acceptance market is also known as bankers acceptance. Why? Because here banks accept their customers' request to pay money at a certain date to a certain person. And mostly these transactions takes place when you are dealing in the import and export business. So whenever you are having the import and export business, in that case you go for the acceptance market itself. So these were the four constituents of our money market, that is the call money market, where you can raise your funds 1 day to 15 days without any collateral security. Then collateral loan, where you have to give the collateral security against your loan, that is up to 1 month. And then you can discount your bills of exchange in the discount market. And lastly, that is acceptance market, when import and export business is there and you have to make the payment. So payment can be done through the acceptance market. So we have certain instruments which we are dealing in the money market. So first of all, these instruments are traded in the organized sectors as well as they are traded in the non-organized sectors. So there is a difference between organized sector and the unorganized sector. When we talk about organized, means that certain regulatory authority is there. For example, in the banking case, RBI is there, which is regulating. So in that case, it will be organized sector. When there is no regulation, in that case, scams can happen for your money. In that case, that is your unorganized sector. So money market instrument under the organized sector, we have 4 types. That is the treasury bills, then is the commercial papers, then certificates of deposits. In the shorter form, it is known as CDs, and the commercial bills. So first, that is the treasury bills. First of all, treasury bills are the most secured instruments. Why? Because these are issued by the RBI on the behalf of government. So that's why there is a no default risk, because government is behind issuing these bills. So it has negotiable, it can be negotiated to n number of persons, and it have a liquidity, that is you can convert into the cash within a short period of time. Then default rate risk is 0 because government is there. behind the issuing part, and then these are issued at discount and redeemed at face value. Uh, which means that, for example, treasury bills are available that is from the minimum amount 25,000 and with the multiples of 25,000, which means that minimum I have to invest 25,000, then multiples of 25,000 means 50,000, 75,000, 1 lakh, and so on. So these are issued in a discount. For example, if I've invested minimum amount 25,000. So if I am purchasing the treasury bill of 25,000, for example, RBI will issue, for example, at the rate 24,000 rupees. So I will be paying 24,000 at the time of purchasing, that is at discount, and when the RBI will give me the back my money, at that time I will get full amount, that is the 25,000. That is why these are issued at discount and redeemed at face value. And mostly the investors who are investing in these, that is mostly all the banks, then financial institutions, non-banking financial institutions, foreign institution investments, state governments, individuals, or even the NRIs are investing in the treasury bills. Second instrument of the money market, that is the commercial papers. So commercial papers are unsecured obligations, first of all, and they are mostly issued by the banks or the corporations for a shorter period of time, that is up to 1 year. And again, these are issued at discount rate and redeemed at par. These are issued with the denomination of 5 lakhs and the multiples of 5 lakh, which means minimum you have to invest 5 lakh, then 10 lakh, then 15 lakh, and so on. And here, who are the investors? Even as an individual, I can invest. Mostly banks are investing in this because heavy amount is there. Then corporate bodies, NRIs, as well as foreign investment institutions are investing in these instruments. And who are the issuers? Mostly the banks, private sector bank or public sector banks can issue, but with the restriction given by the RBI. If RBI allows, in that case, they will issue. If the RBI restricts, they cannot issue the commercial papers. Third instrument, that is the certificate of deposits. Certificate of deposits, again issued by the banks, and these are known as promissory notes. Now the promissory notes are the notes or a contract between the parties where one party, that is here the banks, promises to pay a certain sum of money to a certain person to whom it is described, that instrument, at a certain date, right? So again, this is a time, like a time deposit itself. For example, if you have invested in FD, like a FD, it is there, right? And it in the case of FD, you can't transfer to another person, but here certificate of deposit can be negotiable and it can be given to another person, and it has a marketplace for it. Again, CDs are issued at discount and redeemed at par. So minimum requirement to invest in this is the 1 lakh rupees. So minimum you have to invest 1 lakh and the multiples of 1 lakh, that is 2 lakh, 3 lakh, 4 lakh, and so on. But no mid value is between that. So it has a maturity again of 7 days to 1 year. So again, for a shorter period of time, you can invest in these. Again, issuers who are issuing the certificate of deposit, that is all the scheduled banks, excluding regional rural banks as well as local area banks, and all Indian financial institutions are issuing the certificate of deposit. And now who can invest? Like me, that is the individuals can invest, even the your corporations, your companies can invest in the certificate of deposits for a short period of time. And fourth instrument, that is the commercial bills. Bills are also known as bills of exchange. So it is basically drawn on a certain person, that is mostly the banks accept to pay a certain sum of money to a certain person, that is the holder of the bill, at a future date. And these commercial bills can be discounted before its maturity date in the discount market. Again, these are short term, these are negotiable. You can transfer to many persons, and it has self liquidating. Self liquidating, which means that you can, whenever you are in the requirement of money before its maturity date, you can encash or you can go for to the bank, and bank will discount it in the discount market. So these were the basic instruments under the money market, that is the treasury bills, which are issued by the RBI on the behalf of the government. Then commercial papers, mostly issued by the bankers, and these are unsecured one. Then certificate of deposits, again these are issued by the banks, and these are known as promissory notes. And lastly, the commercial bills, that is the bills of exchange, again given by the banks, and which can be discounted in the discount market before the maturity date. Now, the money market instruments under the unorganized sector, that is, here you should be very, very cautious if you are investing your money in the unorganized sector. So first comes the indigenous bankers. So indigenous bankers are those bankers which are providing the facilities like banks only, but there is no regulatory body behind that. So mostly they charge higher interest rate as compared to the normal bankers, and here requirements are lesser, but scams can happen. Then second are the money lenders, that is mostly the businessmen who have excessive money. They will provide the loans to the person who require it, but here again the rate of interest is very high, and no further requirements are provided, or no paperwork is required in this case. Then lastly, that is the chit fund companies. Chit fund companies comes under the unregistered firms as well as unregistered. If you go for unregistered firm, that again will be very, very riskier for you. So if you are investing in chit fund companies, in that case, you should go for the registered companies. Now, chit fund companies, what they do? They first of all make their members. Once the members are formed, every member have to give certain amount of money every month, and few will get the payment, that is the funds, every month, that is through lotteries or through whatever the basis they have formed. So by this for example, you have kitty party, you could collect the money and to give the money to a certain person. Like that only the chit fund companies operates. So these were the under the unorganized sector, these were the persons or the bankers, but here the scam can be more because no authority is there to check upon these things. Then comes the capital market. So second market and the major market under the financial market is your capital market. Whenever you want to raise your funds for a longer period of time, that is for for more than 1 year, in that case you will be going through the capital market. So capital market is again a part of financial system in which you will be raising the fund for a long period of time through shares, bonds, preference shares, or the mutual funds. So here again the investors who are having the funds in their hand, they want to invest for a longer period of time to get a return out of it. And there are also the persons or the companies which are having the deficit of money. They will issue their shares in the public, and public will apply for that, and this, by this way they will raise their money. And this capital market is for the long term funds only. So again, capital market is divided into three parts. First is the primary market, secondary market, and the derivative market. So primary market is also known as issuer market or first market for the shares. For example, any company wants to raise their funds for a longer period of time and they want to raise their funds through publicly. In that case, first of all, they will enter through the primary market itself. For example, recently LIC has issued their shares only in the primary market, and even Zomato, when first time they introduce their shares, they also comes through the primary market itself. So it is also known as new issue market, and in this the flow of funds is from the savers to the borrowers only, and money collected is the whatever the company will collect the money that will be utilized by the company in the form of purchasing more plants, buildings to expand their business or to start their new business. So under this primary market, we have four types of instrument or issues are there. That is the public issue, right issue, bonus issue, and the private placement. When you go for public issue means that you are introducing your shares to the public. In that case, you can issue the shares in the form of IPOs or in the form of FPOs. So recently, LIC has issued their IPOs. That is first time they were introducing or disinvestment. They take the decision of disinvestment. In that case, they issue the shares, and that shares were in the form of IPOs. That is the initial public offering itself. Then comes the further public offerings. Further public offerings means that you have introduced your shares in the market itself, but you want to raise your funds again. In that case, you will issue the further public offerings in the market. Second comes the right issues. Right issues means that a company gives the right to the existing shareholders to have the shares first of all. If they agree, the shares will be given to them. If they don't agree, then only that company will go for issuing the shares in the market. For example, in the 2021, Airtel have issued their right issues to the existing shareholders. So first of all, they preferred to give their shares, introducing their shares to the existing shareholders at the certain rate. So if and at that time Airtel agrees that if any shareholder is carrying 14 shares in the company, against that they will get 1 share. So if, for example, if I am carrying 70 shares in my hand, in that case I will get 5 shares, because for 14 shares I will get 1 share only for the existing shareholders. So that is known as right issue. Then comes the bonus issue. Bonus issue means that when companies decides to give the bonus, that is without any payment. In that case, introduce the shares to the existing shareholders only in the form of bonus itself, where the shareholders have not to pay any amount. That is known as bonus issue. And lastly is the private placement. It is opposite to the public issue. Here the private placement means that when you are not giving the shares to the public, not giving the shares to the public, but to the certain shareholders only, or to the certain creditors only in that case. So fourth, that is the private placement. So private placement is opposite to the public issue. In the public issue, we were issuing the shares to the publicly, but here you are not issuing to the public, but basically to a group of or you give the preference to the certain group. In that case, you issue to them. That is known as private placements. For example, when you issue these shares to certain qualified buyers only, which is described by the SEBI, so that is known as private placement. So this was about our primary market. Now the secondary market. Secondary market means that once the shares are issued in the market, then these can be traded in the stock exchanges like BSE or NSE. So that comes under the secondary market. So in the secondary market, investor exchange with each other. So here the company is not issuing the shares, but already which are shares are issued, they are exchanged between the investors itself, so that the market value of the shares can increase. So, under the secondary markets, we have the instruments like equity shares, we have preference shares, we have debentures, bonds, as well as the mutual funds. We have so we have discussed about the primary market, we have discussed about the secondary market, and now the third market under the capital market, that is the derivative market. So derivative market is a market where you want to hedge your risk, because you know that the value of share is volatile in nature, that is within a second of time the value of share will change place. So you want to hedge your risk part. In order to hedge your risk part, you go for the derivative market. Under the financial derivative has a underlying asset to hedge the risk involved in dealing in a financial asset. So here underlying asset will be your share, or it can be your currency also. So basically, underlying asset basically is asset. For example, if I say that the value of share goes on increasing, right? Today the price of share is 5 rupees. Maybe within 1 minute or 2 minutes, it will be 6, 7, 10, or 15. Whatever the amount will change over. So in that case, I make a contract of a future, that is maybe after few days I will purchase these shares at certain rate. So when we are deciding certain rate of a certain asset, that asset will be known as underlying asset. So derivative security is a one whose value is, that is, whenever we are making a contract, the contract value is defined from the value of that asset only, that is the underlying asset only. So that is why it is known as derivative. So we have three types of derivative: forward, futures, and options. So forward contract is the contract of in the future, where two parties make a contract that in the future date they will, that is, a buyer will buy a certain financial instrument from the seller at a certain rate at a certain price. So they negotiate the price at the time of entering a contract, and here the both parties, that is buyer as well as seller, will have the obligation to to make a contract. That is, if for example in the future the market goes not in the favor of buyer or not in the favor of seller, in that case no one will reject the contract, but they have to make the contract. That is, buyer will purchase instrument and the seller will sell the instrument, even though the market was not in the favor of them. Second, that is the futures contract. Again, future contracts are the contracts made between the parties, or for the future time period only, to hedge the risk part only. And in this case, again, the both parties have the obligations, that is market. If the market is in the favor of anyone, or this and it is not favoring the other party, but both the parties have to fulfill the conditions of the contract. So future contracts are more future contracts basically are more safer, because here exchanges are there, that is, for example, BSE is there, NSE is there behind issuing the future contracts, because both parties have to maintain their margins in the exchange. But in the case of forwards, they have no certain market, and or you can say there were no regulatory body to watch them. So forward contracts were riskier, but future contracts are not riskier at all. So future contracts can be of two types, that is, we have commodity futures and we have financial futures. When we talk about commodity futures like you can make a contract of gold, silver, even your eatable products like wheat, or you can say not eatable, but the agriculture products like wheat, rice. So you can make a futures of these, and these comes under the commodity futures. And when you go for the instruments like shares, in that case you will go for the financial futures. Third and the last instrument under the derivative is the option. Here, one parties, so option is basically what? It is a special contract in which one party who buys the option have the right to buy whatever party, whether that party is buyer or that party is seller, they will have the right on such underlying asset at a predefined price. That is, they will again define or predefine their price of the underlying asset beforehand, and uh, to exchange it at a future date. So here two parties, one will be the buyer and one will be seller. So the person who is buying the option will be known as option holder, and the person who is selling the option, that person will be known as option writer or the seller of the option. So when they are exercising option, in that case it will be known as when buying and selling will take place, they will be exercising the option, and the price at which future date will exchange their underlying asset, in that case it will be known as exercise price or striking price. And in this case, the person who is buying the option, in that case he has to pay certain premium to the other party. For example, when you want to opt for buying the shares, and you have also buy the option, in that, for example, in this case you are going to purchase 60 shares. So in this example, two parties are there, buyer and the seller. So buyer want to purchase the shares, for example, 60 shares of Infosys company, right? And in this case, the price of one share is 1,000 rupees, which means that total 60,000 will be paid by the buyer to purchase that shares. But the buyer want to purchase in the September month. Now the August month is going on, and you have to purchase on the September, and at the September, the prices of the share can increase or decrease in any way. So today they decide that buyer will purchase in the month of September 60 shares at the rate of 1,000 rupees. So total will be paid, that is 60,000 rupees. So buying an option, buyer will pay a certain premium to the writer, that is to the seller. That is, for example, 10 rupees per share, they have decided to pay the premium. In that case, buyer of the share will pay rupees 600 as a premium to the seller of the shares. In this case, for example, when September comes, the price of the share comes to rupees 1100, which means that favorable to the buyer, because at that time in the September, if buyer wants to purchase it, he has to give 1100 rupees per share. That is total he has to give 66,000 if actually he wants to purchase it without any buying option. So, but now he is only going to pay, that is 60,000 rupees, because they had an agreement. And here the buyer have the right, not the obligation. So which means that if the market not goes in the favor, that is, if the price go lesser than 1,000, that is 900, buyer will say, I will not purchase it at the rate 1,000, the contract price, because at that time he will be having the loss. So he will not make a contract or reject the contract. It means that he has a right to purchase and reject that contract. So if we say that if everything goes well and the price is 1100 only, in that case, sorry, the market price was 1100, but actually they have a contract of 1000 only. So he will pay, that is total, he will have the profit, you can say that 6000 rupees. How? That is total. If we say with this price, total was the, if he had no contract, he had to pay 66,000 rupees. But actually he has paid 60,000 rupees. So total is 6,000 a profit for him at the month of September. And he has also paid the premium to the seller, that is 600 rupees minus 600. So he will have the profit of 5,400 rupees by making this option contract. So option have two types, that is call option and put option, but here we are not discussing that. We are just giving the meaning of the option itself. So here buyer and seller will make a contract where the buyer of the option will have the right, not the obligation, but seller will have the obligation only to make the contract. Thank you so much.